Well, and now to the big macro data of the day. We are expecting the August IIP data and the September retail inflation numbers in a bit. Latha Venkatesh now joins us with it. Latha, over to you.
Thanks a lot, Ronojoy. These are important numbers as always. More than the IIP, it will be CPI, which will be watched. The governor has already given a double dose. So this number to that extent will not lead to a further action. Ekta's poll, who's also with me incidentally, welcome Ekta. Her poll has thrown up an expectation of 4.5%, 4.49%. If it indeed comes at that level, at 4.49%, then there is a modest month-on-month increase in inflation, which could be because of pulses and onions, which have been the problem area. But that much the market has factored in. If it came above it, the market will, I would assume, lose expectation of further expectations. So we have our panel also joining us in a minute. But Ekta, just give us one word on IIP, and I guess we should be having the numbers.
Yes, well, for IIP, we are expecting around 5%, and that is because of the base impact which will come through this time round, because same time last year, the IIP for August 2014 just about came in at 0.5%. So there is that favorable base which will really help it. I will be watching out for the capital goods as well as the consumer durables, where there will be a strong base impact for both these segments, which will play out on a month-on-month basis. But let's get to our guests. We're waiting by for the data as well. But if we can just get in a question before that, Siddharth Sanyal, Chief India Economist of Barclays, joins in, and we have Manoj Rani of BNP Paribas as well. Siddharth, your expectations on the CPI data?
4.6%, so close to 100 basis point uptick, but nevertheless the overall trend remains very, very well under control.
Okay, Manoj, what is the kind of number that will force the market or cajole the market to expect further action from the Reserve Bank before 2015 is out?
2%? No, I'm just joking.
Okay. All right. No. Is there any expectation of any action from the Reserve Bank in December?
Honestly, I think with what happened at the Fed a couple of weeks ago, and of course the couple of comments made by the governor, really no one expects any action till December, honestly. People will be surprised. In fact, the 50 basis points itself was such a surprise that I don't think the market can take one more surprise.
Okay. In that case, Siddharth, what at all will you watch out for in these numbers? Let me just, for the benefit of those who just joined in, reiterate that Ekta's poll gave us an expectation of 4.5% as the average of several economists, the CPI expectation, and the IIP, which is for August, 1 month lagged, is expected to come in at 5%. Siddharth, what all would you look out for?
Well, per se, if we try to see just this particular print, whether that leads to any policy action, chances are very remote. But having said that, this is a month from where the most favorable base effect will be wearing off, and that's why the numbers will start moving up. So it's important to see how exactly the CPI trajectory pans out, because as of now the RBI is talking about a 5.8% kind of a number in March, which remains an important milestone for them to achieve. Question is whether they achieve it or whether they overachieve it by what margin. Possibly we get an early indication from this print as well as the next
well,
print.
we have the data coming in, and it should come
breaking news, so we were expecting that they were going to give us the number itself. Should be due any time now, and as always, you know, the PIB website is notorious at 5:30 to go on a general strike and not help you get the number on time. But yeah, we are still awaiting the numbers. We must remember that the governor has given you the indication that he has front-loaded, but he has also said that he remains in accommodative stance. So a general breakdown in inflation would perhaps move his hand, but at 4.5%, it would mean that you're not just falling in terms of prices. It would still, a 4.5% inflation would still mean that month-on-month prices are rising by about at least 0.5% or thereabouts. Sajid Chidor also joins us. Sajid, what are you going with?
Our forecast is a little bit higher, I think, for both CPI and for IP. So we're at 4.8% for CPI, 5.3% for IP. Couple of things to note. I think on the IP front, look for a very strong capital goods and consumer durables number. And this is largely on the back of base effects. There's a very favorable base effect in both these sectors. So don't be surprised if these numbers are extremely strong. I think on the inflation front, looking at core inflation, I think was going to be quite crucial. We've seen a softening of generalized inflation pressures over the last 3 months. That's given the RBI some comfort. It'll be important to see if that trend continues, or in fact if things have begun to level off.
Okay, so I would assume you will look at the services numbers more than anything else. Ekta?
Yes, well, Sajid, wanted your thoughts in terms of food inflation. What are you expecting for onions, which is basically vegetables, as well as pulses?
You know, I think food becomes a very tricky part. The good news is we've not seen a broad-based pickup in food prices. I think both because of good government actions at home and favorable price dynamics overseas. But you have seen in the first 10 days of October again that pulse prices continue to go up, and you've seen some categories of vegetables go up. So I don't think it's a cause for concern just as yet, but I think given that we've now had 2 consecutive weak monsoons, and there are question marks about water reservoir levels and therefore the Rabi crop yield, I think one cannot help but think that in the near term, the biggest risk to the headline number is going to come from food price dynamics. So I would want to see first and foremost how much of what we picked up on the ground translated into the CPI print that comes out, because in the past there's been a big disconnect. Some months there's been a very strong translation, other months it's been much weaker.
Okay, well actually we've got some other kind of data, so why don't we get Manoj Rane on that. 66 bips is the cutoff at the auction for the limits in government bonds. How do you react to that, Manoj Rane? People are willing to pay a premium of 66 basis points if they can get, catch hold of government bonds. Was that better than you thought?
Yes, I think it is better than what I thought, and it does show that there is a lot of appetite still, particularly on the government bond side. People have been thirsting for that limit to open up, and that's evident in the cutoff.
Okay, well, we're just awaiting the data from the IIP as well as the CPI, and that's what it should flash for you. It's at 6.4%.
Wow, that's excellent in terms of an IIP performance at least. Well, let's hope that the CPI number also flatters. This looks extremely good, though we, as always, don't have much by way of detail at this point in time. We are still awaiting more numbers. All we have at this point in time is the August industrial output at 6.4%, and our forecast was 5%.
And in fact, it's at the higher end of the range. The highest range that we had was around 6.7%. So it's come at the highest end of the range that we had polled. So that's an excellent number. And the CPI data is bang in line with estimates. It's coming at around 4.41% versus our estimates of around 4.49%.
No, let's be a little more charitable. It's coming a little better than we thought. It's 10 basis points lower than we thought, or 9 basis points lower than we thought. Okay, first thoughts, Sajid, 4.4, way lower than what you thought.
Yes, and I would want to see where that difference is coming from. It's coming from food, it's one thing. It's clearly a very good number. I think the RBI's forecast for this month was 4.5, or whether it's coming from core momentum being even lower than we had forecast. But I think the news really is not going to be the CPI. It's the fact that IP number at 6.4 is a sequential acceleration, seasonally adjusted, of over 1%.
Okay.
And remember, last month's number was a disappointment, but the month before was revised up. So clearly you're getting some momentum in the economy, which you'd expect on the back of such a large terms of trade shock. I think that's the bigger headline.
Okay, we've got a few more numbers. Sajid, the manufacturing has come in, which is of course the big daddy of IIP, has come in at 6.9%. What else do we have? The overall industrial output, April-August, is 4.1%. But importantly, 6.4 is the overall number, and the manufacturing output itself has come at 6.9. So clearly, manufacturing is the one that's taking away the honours. One would want to watch out for electricity, which has been a lag indicator, which has been lagging. But we'll wait for that. Food inflation has come in fairly low at 3.8%. If I'm not mistaken, 3.88 is the number we had on food inflation. Okay, we don't need urban and rural inflation, but industrial output at 6.4, and I think we saw the food inflation as well coming in at 3.88. Want to react to that? Siddharth, 3.88, what had you factored in?
Yeah, that's a very good number. The overall number is slightly lower than what we had been expecting. We were expecting at around 4.6%. So overall number is good. And in case of CPI, food inflation, given that the weight is so high, if we continue to see some kind of a softer number despite bad monsoon, despite pulses and onion prices going up, that's a very heartening sign indeed.
Okay, well, Latha, I've got the breakup in front, so I'll just read out what the inflation rate has been. Cereal and products at 1.38, meat and fish, which has spiked to 5.59, egg at 1.19, milk and products at 5.05, oil and fats at 3.61, fruits at 0.94, vegetables, which is absolutely flat this time, and pulses has gone up to 29.76%.
Actually, let's come to food itself. Food, including beverages, has come at 4.29. Then we straight away go to clothing, 5.97. And clothing and footwear is 6%. Housing has come in at 4.74%. Fuel and light, which is your fuel index, has come in at 5.4, and then come the services. The services index is up 3.34, and the components are as follows: household goods and services 5.6%, health 5.4%, transport and communication minus 0.6%, recreation amusement 4.6%, and education 5.99%, personal care 3.56%. Just visually looking at the numbers, this clearly means that the index is lower than 5.5%. Sajid, first thoughts on services. The governor specifically mentioned that services has fallen from 5.5 to 5.7 in August. This looks like a number lower than 5.5. So clearly on a very good wicket.
Latha, I want to hold back on that until I get the core number. One comment on that. For me, the big surprise is food. Our forecast for food was above 5%. You're telling me it's 3.9.
Yes.
So that's where the big surprises come for headline CPI, which is really good news. But let me just wait and get the core number before I comment on services inflation.
Well, I can tell you that for your core number, transport and communication has come in negative. So you will have to add on a few points to the other indices. But household has come in at 5.6. That is, and the other one, education, has come in at 5.9. So that is above 5.5%. But health has come in at 5.45. Personal care coming in at 3.56. And recreation and amusement coming in at 4.6. Okay, actually that brings, that's given us all the numbers now. Any thoughts on these issues, Siddharth?
Well, overall, I'd say the broad take will be if food inflation is around 4%, and even if you exclude the fuel-driven transport part, none of the items in the services segment is beyond 6, more in the low 5% handle. I think the overall benign trend in inflation which we are seeing, by and large, is a pretty broad-based one. There is no change in that, so it should be a relatively comfortable situation. Given that there had been a lot of easing, there will not really be any expectation of any easing anytime soon, but this should give a lot of comfort going ahead for policymakers into the start of 2016, where there is potentially a bit of uptick in the numbers solely because of the
Let's stick to the word uptick, Siddharth. Capital goods is 21.8.
Absolutely.
Okay, and basic goods 3.4. Intermediate goods 2.6. Consumer goods I cannot make out because of the nature of
durables is 17%. Consumer non-durables is 0.4%, and the entire basket is, I think, it's 6.8%. So that's a good growth coming in. But remember, for consumer durables, we have that big base impact also along with capital goods this time round. Durables is 17% growth this time, and we have non-durables, which is absolutely flat, 0.4% in terms of a growth this time. Sajid, how would you read that in terms of even rural demand?
Okay, I'll just give you the electricity and mining as well. Electricity came in at 5.6%, which of course has been an index that's not been doing as well as it did in 2014. And mining has come in at 3.8%. Manufacturing takes away the honours with 6.9%. Sajid, on IIP itself, your thoughts?
So a couple of things that we now have the core number, and I don't want to be alarmist here, but the first cut of the core number was 5.5% for September versus 4.8% for August. So, so the on a seasonally adjusted basis, that's about a 0.6 or 0.7% increase month on month for core, which, you know, it's 1 month's data. We should not get alarmed. I agree with Siddharth generally that inflation pressures are benign, but just to point that out, that month on month core inflation momentum has picked up materially over the last 3 months.
So it's risen to 5.8.
5.47 is this month's number for core.
Okay.
You know, which if you have which suggests a 0.7% month on month seasonally adjusted. Okay. So that's where we are on core, okay. And which lines up with my earlier comment that the bulk of the surprise came on food. Expectations were food inflation would be above 5%, given what we track on a high frequency basis, but it was actually 3.9. So that's where you've got the 30-40 basis points of downside surprise in headline, which again is good news. The fact that food prices aren't going up in a drought year suggests very good food management by the government. On the IP number, I just wanted to get some more details from you. I didn't quite pick up what you said on consumer durables, non-durables, and capital goods, because those for me will be the key movers.
Durables is 17% growth this time. Non-durables is 0.4% charges, and capital goods is a growth of 21.5%.
Yeah. So remember, I began by saying there's a big favorable base effect for durables and capital goods. Capital goods is all base effect. On a month-on-month basis, it's actually come down a little bit. But the good news here is durables, because even accounting for the base effect, you're looking at a durables increase of nearly 10% month-on-month, which again, you know, lines up with the fact that over the last 3 or 4 months, if you take away the monthly noise, consumer durables production in the IP has actually been quite strong on the back of, you know, lower urban inflation and therefore more urban purchasing power. The non-durables number is a little bit more disappointing, but you'd expect that given that rural demand may not be firing on the back of a drought here.
Okay, so your short point on inflation is that food inflation is a pleasant surprise, but services inflation is marginally higher. What you have chosen to call core is marginally higher and actually reversing the trend, because from July to August we saw it fall by 20 basis points, but from August to September it has risen marginally. Would that be your inflation comment?
That's right. So on a year-on-year basis, core inflation has gone from 5.3 back to 5.5.
Okay.
But I think the slightly more ominous part is that the momentum, the month-on-month seasonally adjusted change in core prices in September went up at 0.7% compared to only 0.2% increases in the last 2 months. So that momentum is now back to where it was in the March, April, May sort of quarter. But again, don't want to overinterpret any one data point. Let's see if this pans out. And you know, this should not be surprising. If we are saying growth is actually picking up, urban consumption is picking up on the back of this terms of trade shock, you know, we should not be surprised that in the non-tradable sector, which services largely are, if demand's picking up at the margin, pricing power could be picking up. This is very different from the tradable sector, which is governed by the law of one price internationally. So I would generally agree with the fact that this is a positive inflation number, but it's being driven largely by pleasant surprises on food. Underlying pressures may have tightened slightly.
Okay. Well, we just want to reiterate that number which we were putting out on the flash. Cereals are down to 1.38%. Now, that's saying a lot. Cereals has a huge weight in the index. As well, we must remember that these cereal numbers are coming on 2 bad years of monsoon, 2 bad kharifs, and you know, the impact on inflation has been muted. Speaks of some decent distribution. The others are, of course, not so much government supply, but more inflation expectations and availability factors. So there, just to reiterate what Ekta just read, 5.6% was for meat and fish, egg 1.2%, milk 5%, fruit 1%, vegetables no change at all, pulses, which means, I mean, onions really are not an issue. Pulses is the one that's rising at 30%, 29.7 to be precise. So that anyway gives you a very benign average in terms of food prices. As we told you, 3.88 is the overall food. Okay, August CPI has been revised to 3.74, so it's slightly higher than what we thought. Well, that's the comment on CPI. We'll come back on CPI in just a minute, but let us smile about the other pleasant numbers that we have got, the IIP numbers, excellent numbers. Siddharth, what would your comment be? Consumer durables, 17%, and capital goods, 21.5%.
Yeah, certainly much better than what we had been factoring in. Now, just one factor here. In this particular year, 2015, the festival season is little backloaded, and we are talking about production here 1 or 2 months ahead of festival season, which typically picks up, and that can be playing out at this moment why the numbers are slightly higher. So we really need to be sure whether this kind of a trend holds in the next 1 or 2 prints when the festival-related production will get over. So very clearly that might actually explain the the consumer durables production.
You know, Siddharth,
in general, what we are seeing.
Siddharth, all the durable manufacturers we speak with, and especially even FMCG companies, normally say don't expect the restocking to happen in August. In fact, their point was because there is Diwali is later on this time, the restocking won't even show in the second quarter, not even in September. The restocking could happen in October. So actually there were a lot of people explaining away the September numbers as saying that restocking will happen a little later. I think you have to give a little more credit to the August numbers, no?
Sure. If that particular trend continues in the next 1 or 2 months, we possibly have to really revisit the numbers. As of now, the IIP series has been so slippery for such a long time. We really would possibly like to wait and really see whether there is a big uptick. But one thing is becoming increasingly clearer, that the base for IIP is settling somewhere in the low to mid single digit kind of a growth rate. So the kind of numbers which we used to see in 2014 also at times in the negative zone or at times in the very low single digit zone, we'll be surprised if it goes back and settles there. So we are talking more in the range of low to mid single digit. Whether it's decisively cross mid single digit, we really need to see. We are not too sure already.
Okay, Manoj, we had the yield which closed at around 7.57, 7.58 today. How do you expect it to open tomorrow?
So, you know, if I have to start out doing something in the market tomorrow, what would I look at? Obviously, I'd focus at the 6.4 rather than the 4.38, right? Because obviously both your poll as well as the Reuters poll are bang on both sides of where the number has really come. So really speaking, if you're going to focus on the 6.4, I do feel that you have a more or less a base already formed for the 10-year yields, and to expect them to go down from here, you really need numbers to come aggressively different. You know, I think market will be more and more convinced.
Okay, Manoj, we just I think lost you for a minute, but we will come back to you. Sajid, can we wax eloquent on the very good IIP numbers? April to August is 4.1%. August itself is 6.4%. I think this is a pleasing set of numbers at a time when you're not getting any help from exports. If production is still rising so much, I mean, there's something to say for growth. We've had only dismal numbers coming for growth, from several of the lead indicators. Should this be put a positive spin, or will we once again go back and sulk and say IIP is anyway not reliable?
No, I think this is a positive number, and I think we need to give ourselves more credit on the growth front. I have been saying for the last several months that yes, this is an uneven recovery. Exports have struggled in the last 2 months. The rural economy is weak. But for the last 4 or 5 months, we've been saying repeatedly there are signs that urban consumption is picking up, and there are signs that there's some infrastructure-led capital goods production happening. If you smooth through all the noise and look at capital goods production in the last 6 months, there is a discernible pickup. So I'm of the view that India is experiencing a modest cyclical recovery, and this should be no surprise. This is a textbook response to what happens when a large commodity importer sees this massive terms of trade shock, where oil goes from 110 to 50, inflation comes down, purchasing power picks up, and corporate margins get some help from lower input prices. So I think this fits into that narrative. Are there stress points? Absolutely. The rural economy and exports. but at least urban consumption and infrastructure are giving you some growth buoyancy, and I think the IIP numbers over the last few months, not just this month, have reflected that. So this is, I think, a good number, and we should not shortchange ourselves.
So you will change your full year industrial or GDP numbers, GVA numbers, Sajid?
Not as yet. We've already been on the higher end. We actually have a growth pickup, which is 50 basis points year on year. So we're at the higher end. We are expecting some pickup in the second half in terms of IIP. We won't make any more changes for now. And I think the fact that this should all be consistent, right? The fact that core momentum has also picked up in the month of September is further evidence. It's not worrisome or ominous from an inflation perspective, but it's further evidence that demand and activity may in fact be picking up.
Okay, Manoj, so where do you expect the yield to soften to maybe if we are concentrating on IIP? Or harden rather?
Yes, certainly. You know, I don't know where you lost me last time, but the point is that at 7.57, I think it remains there as a base. I'd be really surprised if it edges down from here, unless there are very aggressive, you know, falls further on the inflation side and growth also comes off. So that really, I think, market is more and more convinced that growth is here to stay.
Okay.
I think it is certainly good for equities, but on the debt side, you might see more or less yields kind of form a base at
this 66 basis point premium that foreigners have paid to put their foot in to buy G6 will not have any impact, Manoj, on yields tomorrow?
So two things, Latha. One is that when you paid already 66 basis points, you're not going to go and bid up bond prices accordingly, right? Number one. Number two, more importantly, I think it's just 16,000 crores, right? 16,000 crores is just about 1.5 auctions. So I don't really think it's going to have a really make or break kind of impact on market yields.
Okay. Fair enough. We have an equity expert also joining us. As you said, the equity markets should cheer these numbers much more than debt markets. Manoj, Ambarish Baliga joins us. Ambarish, the IIP numbers are better than we have ever seen for the last 3 years. October of 2012 is what you said. So this is a 36-month high of 6.4% that we have scored on the IIP, and you know, a good 2.5 percentage points higher than what Ekta's poll threw up. Sorry, 1.5 percentage points. She was expecting 5% for IIP, and we've got 6.4%. Tomorrow, what might you expect by way of reaction? And by the way, capital goods is 22% higher, 21.8, and consumer durable 17% higher.
Capital goods is anyway quite volatile, but then overall, I think the IIP data as well as the CPI figures were much better than what the market was expecting. So clearly, I think tomorrow we should open with a gap, unless, of course, nothing really goes wrong with the global markets this evening. I think our market should open with a gap, maybe at levels of what we saw this morning, or maybe slightly higher than that. But then finally, I think these figures need to get converted into corporate earnings. And the question is whether that will get converted in December or whether it will get converted in March 2016.
Okay, Amrish, just hold that thought. Let's just go back to Siddharth for a quick question with regards to growth. Siddharth, what are you expecting in terms of the GVA figure for maybe this coming quarter as well as for the entire fiscal? And are you confident enough to rework your numbers a little bit on the industrial side?
Well, we publish more in terms of the headline GDP number, and there we are also slightly on the higher side of the spectrum, I guess. So we are talking about 50 basis point acceleration in growth number during the course of the year.
Why don't you give us your number?
Depends quite. 7.8%.
Okay.
7.8%. So
and you won't change it because of this IIP number?
As of now, no. And possibly we get an opportunity only once we see the second quarter number.
And Sajid, what about you? Where do you stand on your GDP forecast or GVA forecast?
Yeah, so for the GDP forecast, we're also, like I said, at 7.8 for the full year, which is a 50 basis point acceleration. There are a lot of issues with GDP. Let's not get into that, but that's what we're expecting year on year. You know, I think we should realize that industry is a small chunk of GDP. This is 1 month's data, so I don't think this will induce us to change it. But we have a pretty substantial acceleration despite the drought and the weakness in the global economy. So I think the risks are balanced, or if anything, slightly to the downside. But today's number is clearly good news.
Okay, actually, let's hear it from the equity investor as well. Inflation is 10 basis points lower than expected, Ambarish, and IIP industrial output is 1.5 percentage points, or actually 140 basis points higher than expected. What should the markets do?
No, like I said, we should open with a gap tomorrow, maybe closer to about 80 to 40, 80 to 50 levels. But the big question is whether it actually holds on post that, because even today we have seen a decent amount of selling coming at higher levels. So again, going ahead, the big question is whether the corporate numbers which will be announced going ahead over the next 2 to 3 weeks, whether they would support the markets at higher levels. But I don't think there's any doubt that we'll open as a gap tomorrow.
All right. Manoj, Ambarish, Sajid, Siddharth, all of you, thank you very much for joining us in this discussion of two key macroeconomic indicators that we got today. The September inflation number has come in at 4.41% against expectations of 4.49%. So it's better than expected. The improvement largely because food prices did not rise. They were up only by 3.9%. Expectations were that pulses and vegetables could play havoc on food prices to some extent, but that's not happened. Pulses have risen, but vegetable inflation has been completely muted, and that is the positive. As you can see, unchanged numbers for vegetable. There has been a slight uptick in services prices, but that could be explained as a 1 month move. Let's wait and see how things pan out. There is no action that can be expected from the Reserve Bank with 1 month's numbers, especially in a month when food inflation has fallen, but services inflation has inched up just a tad. But we are not going to hold back on objectives when it comes to industrial output numbers. For the month of August, they are definitely a spot of cheer. We haven't seen such good numbers for the last, nearly 35 months. October of 2012 being the last time we scored a 6.4% growth. So whatever you may say about base effect, even if you looked at the 4 monthly numbers of capital goods, for instance, which is supposed to be very volatile, it is a growth of 7.5% April to August. It's a 22% growth for the month of August itself. But even if you remove all the fluctuations, you're getting a 7.5% growth. And likewise, if you took the overall industrial output growth, even if it is not 6.4, the average has come at 4.1%. So no complaints at all. Growth is better than what economists have expected, and there should be some cheer in the equity markets on account of that. From Ekta and me, thank you very much for watching us on this special macroeconomics bulletin. Other news carries on in CNBC TV 18 in just a minute.